Hopes of speedy rate cuts fizzle as policymakers stay cautious. Welcome to Market Insight, I'm Elena Casas. After the ECB opened the door to interest rate cuts, other central banks continue to drag their feet. Minneapolis Fed President Neil Kashkari was the latest FOMC member to say on Sunday that just one 25 basis point cut is a reasonable forecast for this year, and it may not come until December. The Bank of England isn't expected to make a move this week either, after a mixed bag of economic data. Well, joining me now to dig into this is Shaan Raithatha, senior economist at Vanguard. Shaan, hi. Why are other central banks so reluctant to follow the ECB?
Hi, and thank you for having me on today. I think the key issue here is the last mile on inflation is proving to be difficult across a number of markets, particularly because services inflation and wage growth remain elevated and sticky.
As you said, the ECB's chief economist Philip Lane also told Reuters this morning there will be further bumps in the road. Do you think the disinflation story will hold up in the single currency bloc, or might we see it go back up?
There are clearly risks to the outlook on the inflation front, and I agree with that sentiment that the inflation outlook will be bumpy over the coming quarters. That said, we are seeing signs from the labour market and for the trajectory for wage growth from surveys and other forward-looking indicators that services inflation will start to moderate significantly over the coming months, and that will pave the way for the ECB to continue to cut rates, perhaps at a quarterly cadence, which means another 2 rate cuts later this year.
Here in the UK, nobody expects a move from the Bank of England this week, of course, but you are expecting one in August, aren't you? But with inflation still appearing stubborn, why do you think there will be space to cut by the end of the summer?
That's correct. We still do expect the rate cutting cycle to start in August. Now, we've had a bit of an upside surprise to the CPI data, to the wage data, and also economic growth since the last meeting. But that said, we see a lot of evidence now, particularly from surveys, that wages are going to start to come down fairly quickly over the coming months. And that will pave the way for the inflation outlook to look a bit more benign, and therefore for the bank to start cutting in August.
Do you think the greater risk then is that the bank waits too long rather than cutting too quickly?
No, I would say the risk is still on the upside there, in the sense that, services inflation is still elevated and we don't want to have any second round effects. That said, it's been clear for a while now that the banks seem to be itching to start cutting rates as soon as the data allows. And that's why we have 2 cuts penciled in for the rest of this year.
What about the Fed then? Policymakers there perhaps trying to manage expectations last week, with the dot plot now pointing to perhaps only one 25 basis point cut this year. Is that what you expect?
We actually have an even more hawkish view than the current dot plot. And we've had this view for a while, that we don't think the Fed will be able to cut rates at all in 2024 in our base case. And that's predicated on the view that services inflation remains elevated for an extended period of time, the economy remains robust, and also the supply side factors that were such a tailwind to growth last year have started to fade slightly this, and that will also have an inflationary impulse. And that's why we think the Fed will actually end up keeping rates on hold.
That forecast is fairly different from most investors. Fed fund futures markets are still predicting a cut in September. Certainly they're hoping for one. Why do you think investor expectations seem to be so out of sync with what Fed policymakers are actually saying?
Well, I think one important element to this, which is often forgotten, is we've had a number of mini cycles like this before, where the inflation data starts to look a bit more promising, financial markets get ahead of themselves and start to price in multiple rate cuts further down the track. But what that does is that eases financial conditions, in some cases significantly, which then propels growth again, and we get into this cycle. And so part of that forecast is also accounting for that reflexivity in markets.
Shaan Raithatha of Vanguard, thank you so much for joining us. Well, that's your Market Insight. You can watch more videos on Reuters.com.